Sectors Made Simple, and today I have a very simple topic. You should learn how to invest when the market's not doing well. Now, that's going to come as a big surprise to many because the reality of it is, if the market's not doing well, why would we learn how to invest? After all, it's not like we can immediately go into the market and suddenly come out with all of our retirement all settled. Well, I'm going to answer that in a couple of different ways. So today we're going to take a look at why I believe that it is very important for us to use a bear market, times when the market isn't doing well, as our opportunity to learn about investments. So, hope you're along for the ride. Let's dive right in. Quick disclaimer, I'm going to talk today a decent bit about my opinion and share some examples to support my opinions. These are my opinions. The goal of this is not to tell you, here is what you should think. The goal here is to share what I believe to be the reasons why it's important to spend this time learning about investments and to be able to help you make a more educated decision about what you want to do with education and with the world of investing as a whole. But as with everything, past results cannot guarantee future performance, which is why it's very important you do your own research prior to making any investment decisions. Alrighty, pretty straightforward. Here's why you should learn how to invest in bear markets. We're going to go into detail about it in today's webinar, but if you're just catching the beginning of this, or if you just want the TLDR of it, the Spark Notes version, here it is. Here are the reasons why I believe it's important to learn to invest during a bear market. First, it's a great way to learn about market and economic cycles. This idea that a bear market isn't an if, it's a when. So the best thing we can do is not fear bear markets and instead understand what they are and realize that they're not as scary as we might think. Hand in hand with that is the realization that if we start learning how to invest during a bear market, it gives us more time to invest during good or bull market. If we've already gone through the paces and learned the basics, we've figured out our strategies and we've got our game plan, when we're ready to hit the ground running, we can sprint. Then there's the very obvious less FOMO. You're not as worried about are you missing out on an opportunity because you're just learning, or it's less likely that you're going to see an opportunity and jump right into it without doing the proper research and possibly lose some money in the process. Hand in hand with that is part of learning how to invest in bear markets is finding clearer opportunities for buying. There are many different ways to figure out what and when we could buy it, and those opportunities will be much more abundant, not so much during a bear market, but as we are moving out of that bear market. So understanding what those signals are ahead of time makes our job a lot easier. Also, it's just easier to find and invest in undervalued companies. There's this small investor that is known as Warren Buffett. He has created an empire of investments and has become an idol for many investors, not because he takes the biggest risks or because he maximizes his profit. No. His whole approach to investing is finding the diamond in the rough, finding the bargain at the Goodwill, going through and spending the time to find companies that might be worth more than they're actually selling for today. All of these are things that we can do, and none of them are particularly difficult. So I want to explore these in more detail with you. But before we get to that, I want to talk a little bit about Sectors Made Simple. That's our YouTube channel, it's our company, it's our website, it is everything. So Sectors Made Simple is not just a corporation with a bunch of suits and ties. If you notice, I'm doing this webinar in a comfy t-shirt. The reality of it is, Sectors Made Simple is run by a group of family and friends. The educators are myself and my mom. My mom often does the Spanish side of our education, as well as we have Nate, which is one of my best friends from college, doing all of our tools development, and my wife, Kira, doing all of our social media and a lot of our communication. So this isn't some big corporation where you try and email support and you're getting connected to some support center that's outsourced to not the US. We are Sectors Made Simple, and we take a lot of pride in being able to offer you all real approachable education and tools for investing. Not to show you, here is the sexy part of investing that does exist, but the reality of it is, investing is so much more than that. It's not about the high risk, high reward, exhilarating roller coaster ride that you might see elsewhere. It's also about calm, calculated, collected decisions that we can use to grow our money consistently over a longer period of time. We create both tools and education here at Sectors Made Simple. Our tools focus on finding market leaders, identifying who those diamonds in the rough might be, and to find buy opportunities based on widely accepted trends and strategies. Yes, there's a time and a place for the crazy risky stuff, but there's also time to go back to basics and keep it simple, silly. Then our education is the other half of Sectors Made Simple. We have done webinars every single week for subscribers for almost 5 years now. And these education topics are really talking about anything in the world of investments, economics, and, where applicable, current events and how they apply to the market. These webinars are available to watch on our website, SMS Learn. The website for that is learn.sectorsmadesimple.com. You can go there and with a free account, enjoy all of our introduction to investing content, a brief overview of how our tools work and what they can do for you, and if you purchase a subscription, you get access to all of our recorded content. But to keep things fun, we are doing a special event right now called Matrix, where for the month of May 2025, all of the webinars on our Learn site are free to watch for everyone. So, if there was never a better time to learn how to invest, this should incentivize you even more. There is so much material for you to explore, plus our helpful AI that will make it easy to find videos that you are interested in and help you learn exactly what you want. So, we'll come back to that in a little bit. But for right now, let's get on to the content of this video. It's not just a sales pitch, I promise. We're going to dive in and talk about what exactly a bear market is. If I'm going to tell you that it's important to learn how to invest in a bear market, I should also tell you what a bear market is. It is a period of time where stocks are generally going down in value. Now, this can be a whole bunch of stuff. It could happen all at once. It could happen gradually over time. But the way that we figure it out is we measure from the highest price in the market to the lowest price in the market. So if we were to look at the S&P 500, which by many is considered to be the market, it's over 3/4 of the entire value of the US stock market. So we think of that as the market. It reached a high price on February 19th, 2025 at $613.23 for the fund SPY. Basically just a way of buying the S&P 500. And on April 7th, it hit a low of 481.80. That is a loss of 21.44%. And anything that is 20% or larger is considered to be a bear market. So by the very, very simple, just draw a line kind of evaluation, technically, we're in a bear market. But it's not an exact science. And if we are or are not in a bear market might depend on who you ask. many investors might argue that we're not actually in a bear market. Now, the S&P 500 did dip below 20%. I'm not just creating some numbers to try and tell my story. It did dip below 20%, but it didn't stay there for very long. In fact, by the end of the day, when we hit that low, it had already bounced back up to a loss of only 19%. It's almost like investors saw that we were hitting that bear market line, and just like the groundhog on Groundhog Day, saw its shadow and went back into its hole. Except in this case, it went back into the stock market and drove prices up just a little bit. So instead of just giving you the answer of if today, which is May 13th, if we are or are not in a bear market, I instead want to talk about some arguments for and against it. The goal here is that in the future, you can decide for yourself if we are in a bear market or not. So here are a couple of points defending why I believe we are currently in a bear market. Investor fears are high. The reality of it is, more than half of investors feel that we are going to be in a bear market within 6 months. That's not to say that we aren't in one already or they don't think we're in one already. 6 months from now, over half of investors believe we will be in a bear market. Compare that to only about 30% of investors that believe we'll be in a bull market. So investors are fairly concerned and their fears are high. When fears are high, it's more likely that people will have a very calm and rational response to changes in the world. That's a joke they're going to lose their heads and run around screaming. Welcome to investments. So when investor fears are high, the reality of it is we are more likely to see losses than we are gains. But also recession fears are high. We've talked a little bit about a bear market, and we will talk a little bit more later about a recession, but these ideas often go hand in hand. The market's in the toilet or the economy's in the toilet. Recessions talk about the economy. So many believe that the economy is headed towards a recession. They'll look at something like our gross domestic production or GDP. They'll look at inflation and try and defend why they think we're going into a recession. But major banks such as Goldman Sachs do believe there is over a 50% chance of a recession in 2025, which does give more kind of credibility to we are in a bear market, or at least the atmosphere of one. And then, because of that, bear markets begin before recessions. It is pretty common to see a bear market begin, and then following it, we will enter into a recession. The market typically moves before the economy does. Why? Investors don't want to be caught holding the bag. Investors want to be able to look at us and say, all right, recession's coming. I'm going to move my money somewhere safe. So it's very common to see a bear market begin and the market go into the toilet before the economy does. And then the obvious. Yes, the market did fall below 20%. The S&P 500 did drop below 20% for a couple of hours. But if we look other places in the market, such as the NASDAQ, which is a group of predominantly technology companies, the NASDAQ actually went below 20% and held that line for over a week. So depending on where you look and who you ask, yes, we did fall below 20% for some time. Now, the arguments against it. There aren't many, but I will say that they're very valid. Bear markets are typically extended periods of losses. We are talking months, usually more than weeks, usually months, not days, of losses. where we will see the market lose 20, 25, 30, 35% of its value over that period of time. We watched the market drop like a rock and then bounce off the ground in a matter of days. Now, part of that is because the reasons that the market was dropping were extraordinary, for the lack of a better term. But the reality of it is, if what we want to say is a bear market is a continuous period of losses, we're not that. We hit bottom and in a matter of hours and days saw an immediate recovery with one of the strongest days in market history. Then also, the very obvious, well, the S&P didn't actually close below 20%. It closed 19% below its high on April 7th. Whether you believe we're in a bear market or not, the end of the story is really the same. It really doesn't matter if we call it a bear market or not. We've actually had bear markets that have lasted 1 month. Back in 2020, there was some global events that caused the stock market to drop over 30% between February and March. It was the shortest bear market in history, but it was a bear market. And just because we have a bear market and it has this definition of 20% or more, that doesn't mean that anything short of that isn't remarkable as well. There are market corrections, which are periods where the stock market drops 10% or more. These are fairly common. And in fact, if we look over the past 75 years of the stock market, a correction occurs once every 2 years on average. So bear markets might be few and far between, with 2020 being the last bear market, and the one before that being all the way back in the Great Recession of 2007 to 2008. But corrections happen far more frequently. And the reality of it is, if we call 2025 a bear market or not, it doesn't change this. These events, the market going down, is not a matter of if, it is when. This is backward. But regardless, if we're investing for fun or investing for the long run, the same thing will happen. We're going to run into bear markets. We're going to run into corrections. So a valuable skill for us is to learn how to handle them. And also, if this is assuming you're already up and running with your investments, short of that, if there's ever a time to start, now is it. Times where the market is not doing well are the best times to start learning. And that's why we're doing today's topic. It's meant to combat the very common opinion, and one that I actually had myself way back when. Why would I learn to invest if the stock market is going down? I understand. If that is where your head's at, I understand that, because that's where my head has been as well. I was doing a stock market competition back in 2008, where my class was up against a bunch of other schools in California, and it was a game to see who could make the most return over that period of time. Our semester started in September. The market collapsed in October. So what did I do? I spent that time learning. A bunch of other people were trying to invest when the market was doing poorly, and they weren't doing too hot. Instead, I sat on some cash, spent some time learning more about the world of investments, tried understanding why the market was going down, and started to look at what does it look like when the market recovers. Waited until that recovery began, immediately started investing with that newfound knowledge, and ended up winning that statewide competition. This was 8th grade. So it's a little while ago, but it's a great example of taking advantage of a period where there aren't many opportunities in the market. Instead, the opportunities are us having time to learn. So when the market recovers, we're ready to go. So the goal here is to highlight how we can take any time that the market's dropping, correction, bear market, or anything really, and use it as a way of learning and sometimes even earning. To give you some comfort, there has been some very bad times in the stock market. I'm not going to pretend otherwise. But there has never, ever been a bear market that we haven't recovered from. And bull market, best times in the market, last longer than bear markets. So I want to dive into the reasons that we talked about earlier of why you should learn to invest during bear market. And the first reason was the market and economic cycles. We're going to just briefly touch on this because this is a whole style of thinking unto itself and one that we do talk about quite a bit here at Sectors Made Simple, called sector rotation. That's not the goal today. I'm going to instead show you why you should care about this in terms of starting to learn during a bear market. What you just saw, what you are seeing right now is the history of bull markets and bear markets through the past 75 years. You'll notice that the period in blue right now, those are the bear market. Those are the bull market. They last significantly longer. And again, there's never been a bear market that we haven't recovered from. So that is the example of the stock market cycle. It is a line that is, or I guess it's going this way, that's going up and down and up and down, but the trend over time is positive. It might take a little bit. There have been some pretty large events in the past, such as the Great Depression, that yes, it took years for the market to recover, but it recovered. There's never been a bear market or market downturn that we haven't recovered from. But here's another way of looking at that same cycle and putting a couple of emotions to that cycle. Now, what I want you to realize is that bull markets and bear markets alternate. The green is a bull market, the red is a bear market. But these changes, these alternations, is that the right word? We're going to say it is. They don't happen instantly. Instead, they flow. It'll go from a bull market and then come around into a bear market. So bull markets will slow down. That excitement slows down and then starts to tip. And then we speed up into a bear market as we go through unease, into panic. And then at a certain point, we find the bottom. And then from that bottom, we gain hope, relief, and optimism. And the thing is, this cycle isn't alone, because this is talking a decent bit about a bigger idea. Notice something interesting about this chart. There's a gray line that sits in the middle here. And that gray line is there for a very good reason. Everything above that line, the momentum, the feeling in the market is pushing it down. We're going up, but people are starting to freak out. They're not sure when things are going to go down. They're getting really worried. Oh no, things are going down. Sell, 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 sell. Panic, panic, panic. All right, I'm done panicking. Now let's pick up the pieces. This momentum is extremely important because what it means is that the momentum in the market, us starting to pull ourselves out of that bear market, doesn't start when the bear market ends. starts about halfway through it. So the momentum in the market starts to change direction positively before the price does. So if we wait for a bull market to start before learning how to invest, if we wait to see that the market has already come out of a bear market and is recovered, we've already missed some of the best times in the market. We've missed this hope, relief, and optimism phase. And we're already starting to hit the tipping point where we're slowing down, losing that steam, and falling into the cycle once again. So, the beauty of the market cycle is not a game of, oh, can I figure out where in this cycle we are? Are we in a bull market or bear market? You can do that. That's part of it. But it's more than that. It's also thinking about this momentum, this feeling of movement, and if that movement is positive or negative. Before we move on, I do want to differentiate bear markets from recessions, because another boogeyman to our money is a recession. In recessions, people lose their jobs, inflation might be super, super high, and we feel the pressure in the economy. But a recession is not the same as a bear market. They are similar and often connected, but a recession is an economic slowdown, not a market slowdown. In fact, a recession typically begins during a bear market. Over the past 75 years, 2/3 of the bear markets that we've had also had recessions begin during that bear market. But bull markets begin during recessions. That momentum that we saw before, that is what leads us into a bull market. And that begins during the recession. Investors start to put the pieces back together, start to find the companies that we might have treated a little bit too harshly, and we start to take care of them, nurse them back to health. That is where the largest opportunities are. People always say, buy the dip, buy when things are cheap. That's the opportunity. The opportunity isn't it's already up 95, 200%. The opportunity is the market's starting to move in the right direction. We want to be in that trend. So in my opinion, we shouldn't really fear recessions as investors. The best times in the market begin during recessions. Before we go on, by the way, these webinars are recorded live. So we have a couple of questions in chat that I want to answer before we move on, related mostly to current events. What do you think about Trump lowering the tariff on China for 90 days? Is that good or just a stopgap? Great question. Unrelated to this webinar, and that's totally cool. Do I think it's a good thing that Trump lowered tariffs on China? Yes, I do. There is a right way to try and promote growth within a country, and there's a wrong way. There's incentive and punishment. In my personal opinion, incentive is always the better way to go about it. Reward companies for moving production back to the US. Don't create problems that you require everyone to figure out the solution, and whatever happens in the meantime is their problem, not yours. Do I think that the pause on the tariffs is a good thing? 100%. Going back to zero was never the goal. Before Trump, we still had tariffs on China. Tariffs have always been used as a tool by economists and trade to try and bring or protect certain industries. So seeing it not go back to zero is not a problem in my eye. The bigger thing about it, that is the big benefit, is that our entire world exists on cargo ships. Cargo ships transport so much product around the world. And it's the reason that we might have fruit grown in Argentina but be packaged in Thailand for sale in the US. No, seriously, that's an example. That really happens. And the reason is because container ships, if they have to go from point A to point B, they want to have cargo. They want to be making money. So we were seeing a lot of container ships entering and leaving China empty. And when that happens, shipping companies are making less money. They start to run into problems. All of a sudden, that container ship that you wanted to go to the US because stuff has to go from the US to Argentina, that ship's not sailing anymore. So now you've got a problem. Or a bunch of companies stocked up on a lot of inventory before tariffs. So now they've got a bunch of containers sitting in their shipping yard that are holding product but aren't being used. Those containers aren't being used by the shipping company for new stuff. So there's this entire downstream effect called the bullwhip effect, where one small problem becomes a bigger and bigger problem the further in we go, that was going to actually be the real issue. People were saying, oh, inflation is still good. Oh, GDP is still fine. Trump's tariffs are working. The reality of it is we haven't seen the results of those tariffs yet because so many companies tried to prepare for it. Do I think there was going to be some negative consequences from it? 100%. So seeing those tariffs go down gives the world a little bit more time to prepare. I hope that they stay off entirely because, again, incentive is better than punishment because the real people that will be punished will be consumers. The tariff is paid by the importing company. So if Juan de los Palotes Incorporated imports a product that has an 100% tariff, they're going to pass on that 100% tariff to you. So it's a welcome thing to see. I don't think the game's over. Alrighty, back to our conversation about bear markets. And I want to dive into probably the biggest reason, in my opinion, that it's important to learn to invest when the market's not doing well. FOMO. Fear of missing out. This is a very common feeling amongst many people about many things, but notably about investing. Part of it is due to something known as opportunity cost. If I choose to invest in thing A, my money's in thing A. I can't invest it in thing B. But the problem is, all you're going to look at the end of the day is, did thing A make more or less money than thing B? If it made more money, you're going to feel pretty good. If it made less money, you're not going to feel that good. But investing isn't just about gains. It's also about risk. And very rarely do people talk about the risk. How many times have you heard somebody talk about GameStop and how much money that they made buying or shorting GameStop? Those stories are everywhere, especially amongst millennials and Gen Z and the younger investors that are using this as their way of opening a brokerage account and exploring investments for the first time. You're going to see all the stories of people making money. You're not going to see the stories unless you go to somewhere like Wall Street Bets of people losing it all. And when you're kind of gambling instead of investing, there is always that heightened risk, but no one wants to talk about it because it's not as fun as talking about tripling your money in 15 minutes. During good markets or bull markets, there are almost too many opportunities. Sorry, not almost. There are definitely too many opportunities in the market. And you'll hear about them on social media. GameStop is up 500%. Nvidia is going to the moon. Buy now. It will never be this cheap again. Are these things bad investments? Is GameStop a bad investment? Is Nvidia a bad investment? My personal opinion? No. But the thing is, GameStop's chart, back in the days of the Big Short, it was, or wait, no, not Big Short, Dumb Money is the name of the movie. when GameStop was happening, this is what its chart looked like. And obviously, you have your friends that got in at this level right here saying, look how much money I've made. You should too. You should buy GameStop. Hold, hold, hold. In a good market, the chances of these things actually seeing profits is higher, but no one ever talks about the other side of the chart. A lot of people bought there and sold in that first dip. And then probably even more people bought the second spike and lost it on that big crash right after. This is an extreme example, but this is something that happens all across the stock market. You will see and hear excitement about one company. You'll buy in hoping that that excitement continues. And pretty soon after you realize that the reason it was going up was because a lot of people had the same idea as you. Then once there was no more people to continue that cycle, the price started to go down. The first few people sold. Now the price is really going down. Now more people are selling. And that's where a lot of people lose confidence with investing. They try it because their friend told them to open a brokerage account and buy GameStop. They did. They lost half their money. So that can and unfortunately will happen without really learning about investing. So by learning the basics of investing during a bear market, when you're not as worried about that FOMO because, well, the weather's pretty crappy outside. Why are you going to be worried about going out and starting to play baseball when it's still snowing out? Instead, use that time to study, learn, go to a batting range or a batting cage, whatever. So use the time during a bear market to learn. Ask questions like, what makes GameStop a strong or a weak company? There are answers to these questions. Is Nvidia a good company to buy long term? Is Nvidia overpriced or they undervalued at the moment? What does value mean for a company? All of these questions have simple ways of answering them. And there's an entire way of thinking about investing that answers these questions. Fundamental analysis. We're not going to get into detail about it today, but the reason I bring up this term is because if all of this sounds like you, it's not some mysterious thing that you need to go out and seek out on the top of a mountain when the sun reaches its peak. No. Called fundamental analysis, it is one of the two most common ways of understanding and studying stocks. And in my opinion, it's probably one of the easiest. There are a few numbers we can look at that will tell us a lot about that company and what their true value might be. So, that is the reason why FOMO is one of the reasons, or rather less FOMO during a bear market is a great reason why you should learn to invest during them. So when those moments come up, those incredible once-in-a-lifetime generational opportunities, you can differentiate what might be a little bit of overexcitement versus what is genuinely an undervalued company ready to take off. Reason 3, clearer buy signals. It is great to have the intuition and the understanding and the spidey sense of when you should buy a stock. If you figure out where the spidey sense is, can you ship me that radioactive spider, please? The reality of it is, it can be very difficult and kind of confusing to find when to buy a company. Thankfully, there's an entire way of thinking about investing known as technical analysis that covers using the price of a company, figure out when to buy it. The simplest example I can give, something called resistance. It's a very basic idea. Price of a stock goes up, and then stops going up and goes back down. And it stops at a certain price. We know what price it stopped at. So the next time the price gets close to that level, we start thinking and we start worrying. Is it going to stop? Is it going to go up again? Is it going to continue going up? We have so many questions of what happens next. For many people, these resistance levels, the points where this price stopped and went back down, become a buy signal. It's called a resistance barrier, the price where it previously reversed. And many investors will use this level as a way of figuring out where the price going up might run into a little bit of choppy water. And often, it takes something changing. It takes really good news or the market improving, the economy improving, something to help it push through that resistance. Moments when this happens is called or are called breakouts. When we go above that level of resistance, we have broken out above that resistance. And for many strategies, that is considered to be a buy signal. So, taking all this text and simplifying it down to a basic idea, find the price where the previous trend stopped. And if we go above that price in the future, that's a good sign. Simple as that. So, I want to give you an example. Let's check out this chart here. I drew a big fat red line above a couple of these peaks. Why? Well, between February, March, and April, look how many times that level was hit, but not reached. Or not breached, rather. Then all of a sudden, we break past it once, saw our shadow, went back down, played around with it for a while, before we finally bounced off of it one more time and went up. Is it a clear science? No. Unfortunately, reality is very rarely as easy as the textbook. But that's why I wanted to show a real chart, not some basic example from a textbook or from whatever. I wanted to show you what a real price looks like when it is encountering that resistance level. Sometimes it'll inch out above it. Other times it will just hit the barrier and then bounce back down. Now, once we go past resistance, what's next? That's the challenge. Once we've passed that level of resistance, we have no idea where the top of that chart might be. What price is it going to reach before it starts to dip back down? When it dips back down, how much is it going to fall? That's part of the problem. It's the fact that we can see where the buy signal might be, but if we have a chart like this, where's the buy signal? Sure, you can probably point at a level like right here in May and say that that was the buy signal. But if I'm looking at this now in June and I say, should I still buy it? I have no idea. There is no level I can look back at and say it might run into some trouble here. It's off on its own. And we have no idea when, if, and by how much it will drop. So it becomes very tricky to know when the right time to buy is, or if it's even the right thing to buy at all. Everyone always says, buy the dip. But in a bear market, it's very, very easy because a lot of companies have fallen well below their high price. The S&P 500 might be down 20%. That is 20% of its value, which is now 25% of its value that it's going to have to go up by And that's a lot of time and a lot of opportunities that can emerge. The S&P 500 is just a bunch of companies smushed into one thing and given a nice pretty name. So all of these individual companies, they might be going on a buy signal sooner than others. And in most cases, we might not just see one level of resistance, we might see multiple. Here's our example from before. I've drawn the same red line. But there's actually a second one too, because we don't just have one level of resistance. Anytime we had a price stop and then go back down, that forms another resistance barrier. So we have a second layer right here. These lines, these resistances, can be a little tricky to figure out at first using a chart like this, but there are other styles of looking at price, such as point and figure. It is a type of chart that makes it super easy to find levels of resistance. And using that, we can find those companies that are going above their resistance, they're breaking out above resistance, and hopefully forming clear buy signals. That's where our tools can come in. I've explained now why it's so important to learn how to invest when the market's not doing well. It's not that you immediately start throwing your money into the market and seeing what sticks. Can you do that? Yes. But it's taking that time to not feel like you're missing out, like you need to start investing today because you're not sure how long the bull market's going to last. You know it's raining outside, so make yourself a nice hot cup of coffee or hot chocolate, sit down, spend a little bit of time learning and finding what it looks like when the clouds finally start to clear. Our tools can step in and make it easier to find opportunities in the market during any kind of market. So while yes, the overall stock market will be doing fantastic during a bull market, I'm not expecting us to sit on our hands and wait for that day. There are a lot of ways to invest during bear markets. If you're investing long-term for something like retirement, part of that strategy is going to be how you handle a bear market. So it's a great time to learn through practice how to do that. So our tools make it easy to find opportunities for buying on breakouts and tracking market progress and recovery. Unfortunately, we don't have enough time today to dive into a wide range of strategies, but I do want to highlight one strategy with you all. I'm going to go here and open up our tools dashboard, which is available to Sectors Made Simple subscribers. Our subscriptions are available for annual, as well as in the very near future, monthly as well. But if you stay tuned and you create a free account during May, there might be a little bit of sneak peek access to the dashboard coming later on this month. Don't tell Kiera and Nate, please. So this dashboard is where all of our tools are held. Each tool tries to do something a little bit different. If you want a full run through of these tools, check out our webinar from last Tuesday, May 6th. There we go. But for right now, I just want to show you one simple thing. Let's look at the S&P 500 and let's find if there are any companies that have gone on breakouts recently. If what I'm saying, if I want to try and defend what I was talking about before, there should be an easy way to find companies that are going on breakouts and recently going on breakouts. Why? I don't want to know that a company went on a breakout 6 months ago and now all of a sudden we're running into that situation of where's the buy signal? Where's the level I can buy here? So that's what I want. I want a list of companies that have gone on breakouts in the past 7 days. Well, let me show you how easy that is using one of our tools, the S&P 500 screener. These percentages, you can learn about them in that webinar from last week. They just tell you how strong is that company compared to the rest of the market. Higher percent, higher strength. What I care about is the two right columns. I want to find things on a breakout, things that have broken out of resistance, and the ones that have happened most recently. So I'm going to click on Signal, choose Breakout. So now I'm only looking at companies that are already on those resistance breakout. And I'm going to sort by signal date. Today is May 13th. Yesterday was May 12th. And guess what? We had 10, 20, 30, 40, 50, 60, 68 companies go on buy signals yesterday. Are we in a bear market? Maybe, maybe not. But if all I'm concerned about is finding companies that are going on those breakouts and are going on them like right now, here's a list of 68. Do I expect you to go through 68 of them? No. There are other ways that we can narrow down our search. Maybe I really like technology companies, so I can go here and only look at technology companies. Now, that list is just 9. Look at the ones that have the greenest values. This one, it's among the strongest companies. It's in the top 96% of companies, or the top 4% of companies in the S&P 500. It's in a sector I like, and it's on a buy signal. There are so many ways to quickly and easily narrow down this search. And this information updates every single day. So I can come check tomorrow and see what's changed. Again, I have so many webinars that I talk about these tools in more detail. This was not meant to be a start to finish strategy that we should immediately go out and start using. I do encourage you to enjoy some of our other webinars that I do go into full strategies. The goal here, though, was to show you that in any kind of market, there are companies that are going on these buy signals, and how with the right set of tools, finding those companies is super easy. Literally log into the page, click 2 buttons, and you're done. So, to kind of get you started and to continue your education, we want you to go and check out our Learn site. The website is learn.sectorsmadesimple.com. Create a free account. This isn't like free account trial, give us a credit card. No. Free account. You have unlimited access to all of our free webinars. And throughout May, you can watch literally all of our webinars. And if we head over to the website together, first thing I want to show you is your personal learning plan. To make it easier to find the webinars you might be interested in, you can go here, talk to our AI, and get a recommended playlist of webinars for you to watch. But if you want a human to pick out some webinars for you, under webinars, we have our Matrix 2025 Essentials. I've handpicked these webinars because they give you a great introduction to Sectors Made Simple, but furthermore, they give you more resources and knowledge about specific types of investments that do well during recessions and bear markets to help you understand investing simpler. This, again, is completely free to access and to enjoy, so I very much encourage you to go and explore these webinars for yourself. Now, if you want a little bit more personal touch to it, again, We are a family here at Sectors Made Simple, and we care about you and want to help you directly. So if you want to learn more about our tools, our education, or just to see if we can to help you to reach your investment goals simpler, reach out to us. It is incredibly easy, and we love chatting with you all. If you want to actually talk with me face to face, you can schedule a one-on-one meeting with me. The link is sectorsmadesimple.com/one-on-one. If I can copy the link to that. Oh, I broke it. This is why I'm not allowed near technology. I'll post the link in the chat, or if you're watching this recorded, it'll be down in the description or resources. So you can schedule a one-on-one with me, or if you prefer to do it over email, you can also send me an email at support@sectorsmadesimple.com. Si prefieres hablar en español, puedes enviarme un email o puedes hacer un one-on-one conmigo en español también. Briefly translating it for Spanish, we do our best to be fully bilingual here at Sectors Made Simple. So, whether you prefer your content in English o español, estamos aquí para ayudarte. We're here to help you out. But that is all the time that we have for today. Thank you all so much for joining us. I hope that this webinar has inspired you to take the market by the horns, bull market or bear market, and understand that now is the best time to learn to invest. Take advantage of this time, learn, ask questions, enjoy what content we have to offer, and we're always here to help you along your investment journey to invest simpler. Thank you all so much. Take care, and we hope to see you all back for next week's webinar.